The stock market is currently closed for the weekend, so we are looking at the latest official closing figures for Nokia OYJ. As of the final trading bell on Friday afternoon, May 15, 2026, at 4:01 p.m. Eastern Time, Nokia stock closed at exactly $13.95 per share on the New York Stock Exchange, under the ticker symbol NOK, marking a definitive intraday drop of 3.53% for the session, with an absolute value loss of 51 cents. While a simple single-day decline of 3.5% might lead the average retail observer using a basic online investment app to assume that the legacy telecommunications company is hitting a rough patch, the underlying technical narrative reveals a completely different reality. Under the hood, this single-day pullback represents a consolidation phase following a historic multi-week momentum breakout that has seen Nokia stock quietly climb from a low of $3.95 over the past year to near multi-year highs in May 2026. This sudden structural shift in equity pricing is being driven by a massive surge in institutional volume and an unprecedented rapid repositioning of the company from a low-margin hardware provider into a critical player in modern high-performance computational infrastructure. The immediate catalyst that captured the attention of major self-investing players on traditional investing sites was the company's unexpected integration of advanced autonomous network diagnostics. The expectation of the broader market was that Nokia would remain trapped in a cyclical, slow-moving telecommunications infrastructure spending slowdown. The reality, however, is that Nokia has spent the early months of 2026 printing stunning balance sheet metrics, including a massive 49% year-over-year surge in its cloud-related segment during the first quarter of 2026 alone, booking over €1 billion in high-tier computational infrastructure orders in a single 3-month period. This fundamental acceleration caught short sellers completely off guard, triggering a powerful short squeeze that fundamentally broke the long-standing stagnant price patterns that have plagued Nokia stock for nearly a generation. When you look at the major capital flows across online investing platforms, institutional traders are no longer viewing this enterprise through the lens of obsolete mobile phones, but rather as an essential architectural layer for localized corporate networks and decentralized server clusters. Despite this powerful macro recovery, the broader market consensus on popular individual brokerage accounts like Fidelity Investments or the Robinhood app still treats Nokia with an immense amount of historical skepticism. This collective memory creates a fascinating tension because the standard investment thesis suggests that telecommunication suppliers are low-growth, capital-intensive entities bound to the strict capital expenditure budgets of massive wireless carriers. This shared belief is precisely what creates the current contrarian opportunity. Investors log into their Robinhood stock trading accounts looking for high-flying tech names like Nvidia stock or Apple stock, completely overlooking the reality that the foundational plumbing required to route huge amounts of algorithmic data is being redesigned by the exact European hardware companies they wrote off a decade ago. While the retail crowd chases the daily fluctuations of high-profile consumer names, large-scale block trades are flowing through advanced institutional portals like the Interactive Brokers platform, quietly accumulating legacy assets that have suddenly acquired massive hardware pricing power. A deep analysis of the recent stock movement shows that Nokia has been behaving like a high-beta tech equity rather than a sleepy utility. Over the last month, trading volume has repeatedly spiked well above its 3-month moving average, signaling heavy accumulation by institutional wealth management desks. This accumulation became highly visible in mid-May when major research firms, including JP Morgan and Argus, aggressively adjusted their financial assumptions, with some analysts doubling their structural targets and upgrading the equity to a conviction buy. This tier of professional endorsement caused a massive wave of capital allocation across automated platforms like Schwab Intelligent Portfolios and self-directed portfolios on the SoFi trading platform. The technical price action over the past 5 sessions shows a firm establishment of support near the $13 level, proving that institutional buyers are willing to step in and absorb any short-term retail selling. This localized buying pressure is critical because it establishes a higher floor for the stock, allowing long-term investors utilizing a sophisticated intelligent portfolio strategy to build positions without fearing a sudden cataclysmic collapse back to the single-digit range. To truly understand why the current valuation metrics look so distorted, we have to look closely at the company's core operations and historical business model. For years, Nokia operated almost entirely as a cellular equipment vendor, competing fiercely on price against global rivals to supply base stations, antennas, and core routing equipment to mobile network operators. This legacy business model was notoriously low margin and subject to severe cyclical downturns whenever a major wireless deployment cycle reached saturation.
However, the modern version of the company has aggressively pivoted its internal product lines toward private networks, industrial automated connectivity, and specialized optical transport hardware. This means that instead of relying solely on massive commercial carriers, Nokia is now selling secure, localized, high-capacity communication hubs directly to defense contractors, automated manufacturing facilities, and modern fulfillment centers. A prime example of this enterprise shift is their recent strategic partnership with advanced defense tech firms to build localized network installations for specialized military hardware, illustrating an entirely new TAM that simply did not exist during the legacy cellular eras. Comment below how many shares of Nokia stock you currently hold, or if you are choosing to avoid the legacy telecom sector entirely right now. Looking at the financial statement underpinnings accessible via any comprehensive Fidelity brokerage pool or Interactive Brokers account, the balance sheet safety is remarkably solid for a firm trading with this level of newfound momentum. Nokia maintains an exceptionally lean financial profile, carrying over $5 billion in liquid cash reserves against roughly $3 billion in long-term debt liabilities. This net cash position gives the executive team immense flexibility to fund intensive internal research and development without needing to dilute shareholders or borrow capital at high prevailing market rates. While the trailing price-to-earnings multiple has expanded significantly due to the sudden influx of speculative capital, the forward-looking metrics suggest that if the current 49% growth trajectory in cloud infrastructure scales across their broader business segments, the company will quickly generate the net income necessary to normalize its underlying valuation. This structural improvement is exactly what self-directed investors on modern investing sites look for, a fundamentally sound business experiencing a sharp, positive inflection in its core operating margin. When evaluating the future outlook for Nokia stock, the strategic narrative will ultimately be determined by the ongoing tension between short-term macro headwinds and long-term infrastructure demand. In a bearish scenario, global corporate spending on hardware could face a temporary freeze if broader macroeconomic pressures force enterprise clients to scale back their physical facility expansions. This would naturally cause a pullback in Nokia's core order book, potentially dragging the equity back down to test its lower support bands near the $11 mark on popular mobile tracking applications like the SoFi Invest app or the Robinhood Investments interface. Conversely, the bullish catalyst is incredibly compelling. As high-speed corporate network deployments shift from experimental projects to mandatory operational upgrades, the demand for Nokia's automated self-diagnostic routing hardware is expected to experience a multi-year compounding effect. This enterprise demand would firmly validate the aggressive structural upgrades issued by major investment firms, potentially driving the stock past its recent multi-year peaks toward new operational highs. Ultimately, the contrast between market expectation and fundamental reality is what makes Nokia one of the most fascinating case studies in the current equity landscape. The general public expects a stagnant, boring telecommunications vendor defined by past corporate missteps and obsolete consumer hardware. The emerging reality is a highly capitalized, cash-rich infrastructure provider that has successfully embedded its proprietary technology into the most critical capital expenditure cycles of the modern corporate landscape. For individual market participants executing trades through a basic individual brokerage or managing a sophisticated Fidelity trading platform setup, navigating the specific ticker requires looking past daily price wiggles like the recent 3% drop. By focusing entirely on volume trends, institutional accumulation, and the rapid scale of high-margin corporate network orders, investors can clearly separate temporary market noise from a genuine long-term corporate transformation. Whether this momentum fully sustains itself through the latter half of the year depends entirely on execution, but the structural foundation laid down in early 2026 suggests that the old narrative surrounding the stock is officially dead. Disclaimer: this video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends. Subscribe for more updates.